Stag Industrial stock, ticker symbol STAG. Is this the best monthly dividend stock to buy right now? Stag stock is down 34% year to date as of recording this video, while the S&P 500 is down almost 17%. So that's quite a difference. People love Stag because of the monthly dividends, of course. But does this mean that at current valuation, Stag stock is a buy? In this video I'm going to show you real quickly what Stag Industrial does. The historical returns, the fundamental analysis, the dividends, their major competitors, and in the last part I'm giving you my price target to see if Stag is a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about the stock, so please let me know your thoughts in the comments as well. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Stag do? Stag Industrial Incorporation is a real estate investment trust primarily involved in the acquisition and operation of single-tenant industrial properties throughout the United States. The vast majority of the company's real estate portfolio is comprised of warehouse and distribution buildings. Stag Industrial has 111 million square feet across 40 states with 559 buildings. The total US industrial market is more than 1 trillion in size. And as of right now, Stag Industrial has a market share of less than 1%. So this means there's a lot of growth potential. Stag's portfolio spans 60 plus markets and the largest market exposure is less than 8% of the ABR, which is short for Accredited Buyers Representative. The total portfolio includes exposure to 45 industries, with the largest tenant being less than 4% of the ABR. So this looks very well diversified. And we do see some big names in here, such as Amazon, FedEx, Tempur, to name a few. The largest tenant, Amazon, represents only 3%. And 59% of all the tenants have a revenue of $1 billion or more. So this looks also really good to me. Another interesting thing is that the FFO multiple, basically the stock price divided by the FFO, which is one of the best ways to value a REIT, is at 15, while the peer average is at 28.8. So that's quite the difference, and also a big win of Stag. And if we check the FFO in the latest quarter, we see that they reported a $0.56 core FFO, an increase of 7.7% year over year, and easily covers the dividends of $0.36 in the latest quarter. Another interesting thing to see is that the occupancy rate is at 98%, so this comforts me a lot. And now that we know more about Stag Industrial, it's time to check the historical stock price to see what happened there. I decided to include the S&P 500 as a benchmark, and also added FR, EGP and KRC, which are all competitors of Stag. On the 5-year chart we see that Stag had a 38% return including dividends, while the S&P 500 had a 75% return including dividends. So you were better off owning the S&P 500 and had twice the return versus Stag. Both FR and EGP beaten the S&P 500 by quite a margin, while KRC had a minus 20% return. On the 1-year chart we see that Stag had a minus 25% return. Well, the S&P 500 was at only minus 10.9%. Both FR and EGP did again better, while KRC is again the loser with minus 26%. On the 6-month chart we see a minus 17.9% return for Stag. And again underperformed the S&P 500 big time. The S&P 500 returned a minus 7%, which is better than all other stocks in this list. FR and EGP both have a minus 10%. While KRC is at minus 31%. On the 1-month chart we see that Stag Industrial returned a minus 5%, while the S&P 500 is at minus 3%. FR and EGP are both at minus 2%, and KRC is at minus 10%. So in the past 5 years you were better off owning the S&P 500 in terms of returns. But how about the current valuation and the future of this company? Let's find out if Stag is a buy at these valuations by checking the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. I also want to mention that I'm almost at 1000 subscribers, so help me achieving this huge milestone by giving me a subscribe. In return, you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. Stag is a 5.5 billion market cap company with a PE ratio of 25. But since Stag is a REIT, I don't want to focus on the PE ratio, but use the price to FFO to see its valuation. Instead of dividing the stock price by the earnings, we are going to use the FFFO. Right now, Stag Industrial has a price to FFO of 14.5, which could indicate that it's undervalued. Later in this video, I'm going to show you my 3 price targets, so make sure to watch until the end. Next up is revenue. Stag has a 610 million revenue in the 12 trading months. And in this graph we see that revenue went up really nice and steady, which comforts me a lot. The net income is at 220 million, which gives us a profit margin of 36%, which is very nice and also above the 5-year average of 28%. So I do like this number a lot. The next numbers are lower for REITs in general, so I don't mind if they are below my 10% minimum. It's typical for these companies to have lower numbers here. Return on assets is at 2.3% and return on equity is at 6.7%. The most important number here, return on invested capital, is at 3.5%, which is a bit low, even for a REIT. But the good part is that it's above the 5-year average, so it's increasing, which is something I really like. Another typical thing for REITs is that they have higher debt compared to the cash position in general. This is because REITs use debt to grow the business. Right now, operating cash flow is at 364 million and levered free cash flow is at 115 million, while debt is at 2.4 billion, so that's quite the difference. But as I just said, this is typical for REITs. But to be honest, I would love to see cash flow around 500 to 600 million with this amount of debt. So I don't like this number right now. Let's check the free cash flow growth over the past years, because it's very important that this number is growing since this is used to pay down debt of course, but also to buy back shares, do acquisitions and a lot of things. In this graph we see that free cash flow is growing steady over a longer period of time, but there are some years where this was a big decline. So although it's up in the long run, I prefer a bit more steadier and consistent pattern here. Next up are the dividends, a thing that people love about Stag Industrial. Dividend yield is at 4.75% and they pay you a $1.46 annually, or 12 cents each month. So yeah, they don't pay a quarterly dividend, but a monthly dividend. Every single month you receive 12 cents per share. The payout ratio displayed here isn't correctly, since it's based on free cash flow instead of FFO. So if we take the current FFO, which is $0.56, then multiply the monthly dividends times 3 to get a quarterly payout, which is $0.36, then we have a payout ratio of only 64%, which is pretty good to be honest. The 5-year growth rate is really low at only 0.8%, but with the current dividend yield sitting at 4.75%, I don't blame them. They grew the dividends for 10 years in a row, which is pretty impressive. Next up are the fundamentals of Stag versus their major competitors. I decided to include FR, EGP and KRC, all similar companies in terms of market cap and industry. Next up is the valuation. Stag has a 14.5 price to FFO, and both FR and EGP have a price to FFO which is higher. KRC is at only 10, which means they are the cheapest in terms of price to FFO. Stag has the highest revenue compound annual growth rate and also the highest net income compound annual growth rate. Free cash flow is also growing in very high amounts for Stag. Only FR has a higher growth number here. Stag also has the highest gross profit margin, but FR has the highest net income margin. All the competitors also have a higher return on equity, return on assets and return on total capital versus Stag. All companies also have a lot of debt versus the cash position, so no winner here. And last, and for most people the most important one, the dividends. Stag has the highest dividend yield, but the lowest growth rate. But the good part is that Stag has the most consecutive years of dividend growth. So to me, Stag is the winner here. Overall, I think Stag did very well. But does this mean that Stag is a buy right now? Let's find out by checking the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. Definitely check them out. I need to fill in a low, mid and high assumption. But keep in mind that with a REIT it might be not as accurate. Let's start with the revenue growth. I think that revenue will be slowing down a tiny bit, but still will be double digits. And that's also because of the historical growth numbers of this company. So I fill in 12, 14 and 16%. For the profit margin, I think I'm going for the 5-year average for the low assumption which is 28. For the high assumption, I'm taking last year's profits margin, which is 36. For the mid assumption, I'm sitting right between them with 32. Free cash flow margin is a little bit lower, at 28, 29 and 30. For the PE ratio, I'm filling in 16, 17 and 18. But to be honest, this is not my focus area. But still, you don't want to overpay for this company. Same story with the price to free cash flow, while I fill in the same numbers, and to me this is a bit more important with the price targets. My desired annual return is 12.5% since I can get an easy 10% return with owning an ETF. Right now, Stag is at $31 a share. I hit analyze and we see some green numbers here. And to be honest, I'm focusing on the discounted cash flow value, since this is the most reliable in this case for a REIT using this tool. We have a low price target of almost $24, a mid price target of $29.8, which is slightly below the current stock price of $31, and we have a high price target of $37. So if you believe these high numbers, then Stag stock is a buy. To me, the mid to high range of $29 to $37 is the most justified here. Right now I do own Stag, but it's only a small position in my portfolio. I'm thinking to increase my position, and at current prices it might be an interesting dividend and value play. My final conclusion is that I think it's a very interesting price range right now. To be honest, my average cost price on Stag is at $30, so it's not that far away. And I hope the stock will fall down even more, so I can dollar cost average. But still, it's a pretty good deal in my opinion at this price, so I might add more stocks to my portfolio very soon and keep the monthly dividends coming. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I'd really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.